Hi friends, I hope you all are doing really well in your respective lives. So here I, Kunal Nagpal, representing an economic portal, Nagpal Academic Academia, would like to take an opportunity to welcome you all to this great forum. My dear friends, this great academic platform actually helps us to really discuss the great economic matters and the academic topics which are of great significance. And as all of us are quite aware that today's global scenario is actually quite sensitive and unpredictable if we consider the economics, ecology, international trade relationships. They are going through a very sensitive phase. So, in such a scenario, we need to be very well versed with the Indian core strengths and weaknesses so that, being the responsible citizens, we can also give our suggestions which would help our country to deal more effectively in such a critical time period. And we are also well versed with this particular fact that India's performance is actually being acknowledged, being appreciated by the international bodies worldwide. The overall fluctuations being caused in various parameters governing the economics and the entire political scenario of the country is actually very stable. If we do the comparative analysis with the similar factors prevailing in major economies across the globe. And obviously, as we have been discussing, the overall charismatic leadership, well-planned goals, and the optimum utilization of resources and the strategic plans are the real reasons for our stable performance. Obviously, the proactive approach being adopted by our extraordinary leaders in such critical times is actually helping everyone across the globe realize that only a stable mind is actually able to deal with the very critical time period. So, my dear friends, in today's discussion, we are actually going to focus on India's performance in terms of inflation. We are well versed that the economic environment across the globe has been majorly affected because of the 3-4 major breakdowns. The major developments being the COVID pandemic, which is still in the picture, and in the last 3 years it has actually caused a lot of changes in the economic pattern across the globe. Moreover, the Ukraine-Russia war, followed with the disruptions in the supply chains, massive disruptions in the supply chain, and also the adversely affected food and energy sector worldwide. All these factors clubbed together have actually led to the global inflation. And if we consider the Indian economic environment with regard to inflation and the overall efforts being seen across the globe to actually attain an optimum balance between economic growth and minimization of inflation is actually a major area of concern, because as the because as the monetary tightening measures are being undertaken by the government to curb inflation, that is having a massive impact, that is having a drastic impact on the economic growth. So, my dear friends, let's discuss that India is actually not immune to the stagflation that fell upon its neighbors. Dear friends, luckily for India, a part of its 2-year period coincided with the post-COVID-19 reopening. Self-sufficiency in food production, a sizable foreign exchange war chest, and a vast software exports industry actually helped cushion the commodity and hard currency shortages that in various degrees actually hobbled the region's frontier markets, that is Sri Lanka, Pakistan, and Bangladesh. Like all the emerging markets that majorly rely upon the rest of the world for the commodities and capital, India has actually spent the last 2 years battling the twin challenges posed by more expensive raw materials and a stronger dollar. My dear friends, in the past, trouble would come individually, but not as a pair. So, when food, fuel, and fertilizers skyrocketed between 2002 and 2008, the US currency, that is US dollar, was actually quite cheap and available in abundance. So when the greenback surged between 2011 and 2020, the basic ingredients became less costly, and their entire movement in the opposite direction basically tended to offset the overall negative impact on output and prices. But when the two soared in tandem in 2021 and 2022, the stagflation risks increased in commodity importing developing economies. The new research by the Bank for International Settlements has shown this particular fact. And as I quoted, luckily for India, a part of this 2-year period actually coincided with the post-COVID-19 reopening. The self-sufficiency in the food production, a sizable foreign exchange war chest, and a vast software exports industry actually helped cushion the commodity and hard currency shortages that in various degrees hobbled the region's frontier markets, that is Sri Lanka, Pakistan, and Bangladesh. My dear friends, the pent-up demand of the urban professional class actually helped sustain the growth until the expansion in the gross domestic product slowed to 4.4% in the December quarter, with the private consumption increasing by just 2.1% from a year earlier, down from 8.8% in the previous 3 months. So such a sharp deceleration in spending around the major Hindu festivals is actually quite worrisome. So with the investments also starting to slow down from the high growth actually witnessed earlier during this fiscal year, the outlook for the domestic demand has basically turned quite weak. And not much help is actually expected from the global economy. The financial conditions are tight almost everywhere and demand tepid. There is no end in sight to Russia's war in Ukraine. Even China, emerging from its long isolation, has set a modest annual growth target of around 5%. Though the one positive side effect of that may be that the commodity prices won't run away again. The Federal Reserve of the United States of America is actually far from declaring victory on inflation, and some European economies such as Germany and Italy are forecast to basically tip into recession. So dear guys, the tremors in other emerging markets are also causing a ripple effect, with a highly disruptive currency ban in Nigeria contributing to likely production cuts at the Bajaj Auto Limited's Indian factories. The export volumes at the motorcycle maker hit a 30-month low in January. The Nomura Holdings Inc. is predicting that the gross domestic product in the world's fifth biggest economy, that is India, will actually expand 5.3% in the financial year that starts on April 1, way below the central bank's 6.4% forecast. So overall, India's growth drivers are actually slowly fizzling if we talk in entirety of India's overall performance. Its economists Ms. Sonal Verma and Mr. Aurodip Nandi wrote, money is actually quite tight at home. To actually tame persistent core inflation, the Reserve Bank of India, that is RBI, has basically wrung dry the pandemic era excess liquidity and hence raised its benchmark interest rate by 250 basis points. It might have to serve up another 25 basis point increase next month, so taking the terminal rate towards 6.75%, way higher than what was actually expected when the Reserve Bank of India began its campaign last May. My dear friends, the borrowing costs have also risen to a point where the higher mortgage payments could be affecting the household budgets. So at least one external member of the Reserve Bank of India's Monetary Policy Committee is quite uncomfortable. Economic growth appears to be very fragile, says Mr. Jayant Rama Verma, a finance professor at the Indian Institute of Management in Ahmedabad. Moreover, the government of the Prime Minister Shri Narendra Modi ji will have to rely on public spending in order to prevent this fragile growth from cracking. But it actually faces the resource constraints. For one thing, the slower GDP expansion will also mean the muted tax collections. New Delhi is hoping to save money on food and fertilizer subsidies. Yet, climate change is an additional complication, with the heat waves threatening the wheats expected to be a record wheat harvest. So the consumer staple firms are basically betting on an improvement in the farm incomes and rural demand. And if that fails to materialize, the farmers will basically be less than receptive to the higher market rates for the fertilizers. My dear friends, longing for the bigger budget deficits when the investors expect fiscal consolidation won't fly. Nor is it actually realistic to hope New Delhi will raise the resources by stemming up privatization in a pre-election year. The $130 billion stock market scandal involving the infrastructure tycoon Mr. Gautam Adani, even though the businessman claims to have derived no undue benefits from his proximity to Mr. Modi, has actually put the government's commercial decisions under additional scrutiny. It has also left a big buyer of state assets out in the cold. So, while Apple Inc.'s vendors are contemplating the investments in India, primarily to reduce the risk of getting caught in the vortex of the deteriorating US-China relations, there are few discernible signs yet of $24 billion in 5-year government incentives making headway either in creating the factory jobs or reviving the dwindling importance of manufacturing in the economy. In the northern state of Uttar Pradesh, which actually has a population rivaling Brazil, The workforce participation of males aged 20 to 24 years basically fell to a little over 34% in the last quarter of 2022, from nearly 66% before COVID-19. For the female youths, the participation rate was only 3.4%, according to Mr. Mahesh Vyas of CMIE, a think tank. And my dear friends, if I talk about the states where it is actually in power, the opposition parties are fanning the insecurity of the less affluent by signing up the government workers to an old defined benefit pension plan, reversing the 2 decades of reforms and hence introducing a vulnerability to India's weak fiscal foundations. The stagflation risks, heightened by the core movement of the commodity prices and the dollar over the past 2 years, may not have had the same deleterious impact on India as its smaller neighbors. But they haven't exactly left 1.4 billion people unscattered. Now that opening is actually in the rear view mirror. It may be the time to come up with a credible plan to reverse the damage. So, my dear friends, in this session, we have been able to analyze the entire holistic picture of the Indian economy with regard to its overall economic performance. And if I summarize, I would like to state, as I had quoted in my discussion, for India, a part of this 2-year period actually coincided with the post-COVID-19 reopening. The self-sufficiency in the food production, a sizable foreign exchange war chest, and a vast software exports industry actually helped cushion the commodity and the hard currency shortages that in various degrees hobbled the region's frontier markets, Sri Lanka, Pakistan, and Bangladesh. So, my dear friends, I really hope you would have found this session really resourceful and productive, helping you to embrace and restructure and polish your overall knowledge regarding India's performance in such a critical economic scenario which is prevailing worldwide. So, on this note, my dear friends, I would like to conclude here itself, and I really wish you all take excellent care of yourselves until we meet next. Thank you so much. Namaskar. Jai Hind.